Kevin, 2012 looks very interesting. We've got extremely high live cattle prices. We've had strong feeder prices.
Absolutely.
How do you sort of feel about this market right now as we head into March?
Well, as we think about it, especially where we're sitting today, we're at record high prices for pretty much all classes of cattle, and it does give you a little bit of concern as far as, especially we start with the fed cattle market. Seasonally, it typically tops as you go in here to March or April. That's a long-term seasonal, so we'd have to think that we're approaching the top here pretty quickly as we think about that. So once you get that accomplished, then you have to be worried about your spring to summer seasonal drift as far as fed prices are concerned. The cow-calf guy, the prices are stout, they're going to stay strong. We've got less calves if we think about the North American continent. Not only this past year, but this year as well. We are in the process of starting to see a little bit of rebuilding, not only here in Canada, but also in the northern tier states in the U.S. And so I think longer term, that's going to be optimistic for some more numbers. But short term, especially this year and next, it just means as we keep more heifers out of the mix, so to speak, supplies will get tighter and it'll support pretty strong prices.
We've got to shrink before we expand.
Absolutely.
One of the, it's fun to be a part of a rising market. Not so much fun to be a part of a market going down.
Absolutely.
The mood in the U.S., guys, I'm sure, are a little bit worried or are conscious of the potential for a market going substantially lower.
But they are. One thing that's supporting, especially these calf and yearling values, is the commodity complex, the futures. We're going to sell cattle in the U.S. this week right at about $1.30. In fact, there's some that sold that way in Nebraska today, which is record high. At the same time, you look at the futures contracts throughout the year, and their average is about 132, 133. And so we've got a premium built in. We're sitting here close to our seasonal high. At the same time, we've got some premiums built in for the rest of the year. So that's supporting the yearling and calf value. I think we really need to look at the seasonals. They're very strong from spring to summer. Typically, we break the market about 13%. So we need to expect to have a pretty hard break. As you go higher in prices, that percentage becomes more dollars. So,
do you think a lot of those feeders are banking on maybe a potentially high acre of corn planted, and so maybe a lower corn price?
Well, I think that's the mood out there as we think about it. Estimates are anywhere from 3 to 4 million more acres could be potentially planted this year compared to last, and we'd be in the same camp. But we need to recognize also that the demand side of the corn market is very strong too. We're going to continue to use 5 billion bushels for ethanol production in the States. We can continue to export the product. Feed usage will stay strong. So that will give us some relief, we think, if Mother Nature cooperates. But by no means are we going to have cheap grains compared to historical levels.
Well, I was at your CattleFax update at NCBA, and you mentioned your CattleFax is looking at a potential $300 a head swing in fat cattle prices. You still feel that same way?
Absolutely. If you just took a norm, it's a 21% range from your weekly high to your weekly low within a given year for fed cattle prices, and where we're thinking fed prices will average in the low 120s. That's what the math says, that from the high week to the low week this year, we could have a $300 head swing. Tremendous amount of volatility. With these high prices, a tremendous amount of risk and capital exposure, and that's one reason that we think that the risk management piece of our business plan is much more important than it's ever been in the past.
That has definitely become the risk management part has become a much bigger part of the producer's sort of overall daily tasks based on these big price swings.
Absolutely. There's no doubt about it. And as we think about those premiums that the futures market have held, not all the time, but more times than not over the last couple of years, they've afforded us the opportunity to lay off some risk out in front at some elevated prices that, as producers, we need to take advantage of that.
So you mentioned 130 fat price. These are the highs, and
well, seasonally you'd be approaching that, so there might be a little more push over the next couple of weeks, but just from a seasonal time frame, I think we need to expect the highs to come sooner, not later.
Could we be back this high in the fall time?
Oh, absolutely. As you think about the structure of the market, really about 6 of the last 10 years we put our absolute high on a weekly basis in the fourth quarter. Last year is one of those years. And as you think about the market, it is in a longer term uptrend, which supports the fall versus the spring. And also as you think about the choice select spread, which widened last fall, we think it'll continue to stay wider this year than past. That's also a driver for higher prices in the fall when you get that wide spread.
The last couple of years at NCBA, I've heard CattleFax talk about the strength of the export market. That's really been a huge opportunity for the U.S.
Yes.
See that continuing in 2012?
Absolutely. We don't think the rate of increase will go at what we've done the last couple of years has been a 20 to 25% increase, but at higher tonnage levels it takes more to get a percentage change. So we do think exports will increase another 10% this year for the United States. We still feel pretty strongly that the Asian markets is where the biggest increase will be at, but we need to recognize as well that both Mexico and Canada, last year we exported a lot of product, both north and south, and the U.S. dollar probably stays fairly weak again this year, and because of that, our prices are pretty attractive on the global stage.
Well, we should mention Canada in 2011 did over $1 billion worth of business with the U.S.
Absolutely, absolutely. It's a two-way street.
And finally, one of the things that people right away jump on is how can this export market continue with such a weak global economy?
Yeah. Well, as we think about it though, if we look at the U.S. and Canada combined, we're less than 5% of the global population. And also as you look at some of the emerging economies, they're growing at a much faster pace than we are here in North America. And so not only is the mass population out there globally, but also the increase in disposable income is there as well. So from a long-term perspective, we still need to recognize that the world's our marketplace and will continue to be that in the future.
Kevin, thanks a lot, and hopefully we'll get a chance to talk to you again on RealAgriculture.com.
Okay, thank you.